So the Federal Reserve is going to wrap up their meeting tomorrow, and a lot of us are wondering, what is that going to mean for mortgage interest rates? I'm going to give you my 2 cents on that in this video and basically what I think you should expect. Before I dive into that, please make sure to hit the subscribe button, like this video, it helps the algorithms. All right, so let's dive into this. The market's been extremely volatile lately. It seems like you can't open the news without reading about some bank going out of business or some bank getting bought out by somebody else or whatever. There's a lot of uncertainty in the market, and investors hate uncertainty. And so it's been kind of wild to watch this ride over the last couple of weeks with these bank failures, because when there's uncertainty in the market, what you'll see is investors, they flee to safety. Well, what is the safest thing out there? It's the government treasury bonds, the United States 10-year treasury bonds. So you see a flight to safety. Well, a lot of people forget that the Federal Reserve, they do not control mortgage interest rates. So like tomorrow when the Fed raises the rate by 0.25% like everyone's expecting, that does not mean that mortgage rates go up by 0.25%. In fact, it's possible that after tomorrow's meeting that mortgage rates actually go down even though they raise the federal funds rate. The rate that the feds control, that's your credit cards, car payments. I mean, it's basically the rate that they charge banks to borrow money overnight so that they can continue to lend it out to you and me. So it's pretty much certain that the Fed is going to raise it by 1/4 point tomorrow. We're not going to see a 1/2 point. We're probably not going to see no increase as well. I mean, if you look at the Fed futures index, everybody's betting on 1/4 point, all right? We'll find out tomorrow for sure, obviously. But what everybody's really gonna be focused on tomorrow is, what's the plan for the rest of the year? Are there future raises? What are you gonna do with your balance sheet? A lot of people don't realize that recently the feds have actually raised their balance sheet by like over $300 billion, providing liquidity to the banking sector while all these banks are going out of business. Meanwhile, they've just spent the last several months trying to reduce their balance sheet because they're trying to take supply, the money out of the system to bring down inflation. So they've added money to the system, which theoretically should increase inflation. So it's going to be really interesting to hear what they plan on doing for the rest of the year. So if you are somebody that you're in the process of trying to buy a house, you're pre-approved for a mortgage, or you're thinking about getting pre-approved, obviously the interest rate that you're going to be able to lock in is going to play an important role in whether or not you move forward, whether it's affordable, etc. So what everybody's going to be watching for is inflation. Is inflation getting under control? Does the Fed feel like inflation's under control? What are their plans for tackling inflation? Because inflation is the enemy of long-term debt. And a mortgage in its like pure form is a bond, and a bond is a long-term debt. So if inflation persists, you'll see mortgage rates go up. But if it seems like the Fed feels like inflation is trending downward, and that's the way that they are going to proceed in terms of their actions with the Fed funds rate, with their balance sheet, with stimulating the economy, that'll be good for mortgage interest rates, and I would expect to see a rally in the market. On the flip side, if it seems like inflation is building up and that the Fed does not have a clear path to tackling our inflation problem, I would expect to see mortgage rates go up, because again, inflation is the enemy of long-term debt. So interest rates hate inflation. It's their arch nemesis. We'll give you a mortgage rate update after the Fed speaks tomorrow, and we'll let you know how the market's reacting, and we'll see if rates go up or down. We'll see you then.